Hey, welcome back to the channel all about real estate. My name is Lewis, and in today's video, we are going to jump right into analyzing a rental property. For this example, I'm going to use a property in Sacramento, California. But just so you know, all of the numbers, all of the details, everything that I show you here today is going to apply to markets across the country. The main takeaway here that I would like to get across is that when you're analyzing a property as an investment home, it's not just how much rent is coming in and how much your mortgage payment is. There are various other expenses that need to be accounted for, and that's what I'm going to show you today. So if you are new to the channel and you want to hear more about all things finance, real estate, and investing, please consider tapping that subscribe button and smashing that like button below. Let's go. Okay, so the first thing that we are going to do is I'm going to show you where I found the spreadsheet that I use to analyze every single rental property. And it's relatively easy to find. I'm going to go ahead and link to it in the show notes here as well. But you would go to kellerinc.com/pages/resources. And I actually found this in a book that I originally read. It was called Hold. It looks like it's right here, actually. Here, let me go ahead and click on that so you can take a look at it. So the book's called Hold, How to Find, Buy, and Rent Houses for Wealth. And inside they have a set of resources that allow you to use a worksheet. And it's very easy and user-friendly, and it gives you all of the data that I think that you need in order to make an educated decision when you're analyzing rentals. So in order to find it, you go to the website. I'll link below as I mentioned. You would click on Hold, and then you would click on Hold Worksheet 30. They're referring to a 30-year fixed mortgage. They also have a Hold Worksheet for a 15-year fixed. But for this example, we're going to go ahead and use the Hold 30. Okay, so I'm going to go ahead and open up the blank spreadsheet, and let's go ahead and jump in to see if we can find a property to go ahead and analyze. So I went to Zillow.com. I found a property that recently sold, and I just kind of pulled it at random. As I mentioned, we are going to look at a property here in Sacramento. So this property here on Sunchaser Way, it's a 3-bed, 3-bath, about 2,000 square feet. It sold, looks like about a week ago for $535,000. So we'll just use the sold price of $535,000 for purposes of discussion, and then we want to go ahead and check to see roughly how much we think this home will rent for today. But we'll get to that here in a second. So let's get started. We'll go ahead and pull up the worksheet that I mentioned. Okay, so here it is. And you can go ahead and fill out some of the stuff. I always say just work from top to bottom. And I'm going to walk you through all of the details here. Let's go ahead and add the property address. 5220 Sunchaser. And then let's just say the list price was $535,000. Fair market value, let's say, was $535,000 because that's what it sold for. The discount, they are referring to the discount that you got on the property, what you essentially offered on the property, and how much under the list price you got it for. In this case, we will put 0 because we know that it sold for $535,000. And then let's say as a rental property, you are looking to put 20% down. Pretty common on rental properties, but if you're buying it as a primary home, you can always adjust this figure, and maybe your intent is to turn it into a rental down the road, something we can talk about more maybe in another video. So let's just put 20% down. That's $107,000. You're financing $428,000. Now, I realize that this is probably an expensive home for most markets. In California, particularly in the Sacramento region, this is probably a little bit under the actual median home price right now. I think in the Sacramento region, the median home price is sitting somewhere around $650,000. So anyway, it's a good home in a good neighborhood at a decent price point, but let's see how the numbers pencil. Let's say your interest rate on a rental property is 3.25%. That's a 30-year fixed. And the property overall, just based on what I saw, let's pop back over there. Some of these photos, it looked like overall it was in pretty good shape. So let's assume that you don't really have to do a lot of repairs to make this property ready to rent. Let's just say there's $4,000 in cost there. Length of the mortgage is 30 years, which means your monthly payment on that would be $1,862.68. That is your principal and interest. That does not include taxes and insurance, and that's an annual amount of just over $22,000. So now we get to kind of the good part where we analyze the rental income for the property as well as the expenses. I am going to go ahead and show you a website that I generally use to kind of determine roughly what the property will rent for today. That website is called Rentometer.com. I will link to that in the show notes as well. And you can go ahead and plug in the address, and then you can select how many bedrooms it has and how many baths. And then you can click Analyze. Now, this is a paid service. They do allow you to do a couple free searches per month. And then it gives you the average, the median, the 25th percentile, and the 75th percentile. So let's say this property is really nice and it has some good amenities. And let's say, the average is $23.99, but the 75th percentile rents for $26.92. Why don't we just say, for purposes of discussion, this one would rent for $24.95. Now, this is not a guarantee. It is just an estimate. And ultimately, you'd want to talk to a property manager and kind of put your feelers out to maybe analyze the rental income on this one a little bit deeper once you get to that point. So let's go ahead and say the monthly rental income is $24.95. It works out to about $30,000 annually. Now, this is just one unit. This worksheet allows you to analyze up to 4 units. So if you have like a duplex or a triplex or a fourplex, you can plug in the additional rental incomes that you receive here on the different units all the way up to unit D. So 1, 2, 3, 4. Now, vacancy rate is really important. This is something that you're going to want to talk to a property manager about to get an idea of how long these properties sit vacant before they are occupied by a tenant. I think if your market is really hot, it's probably going to be somewhere between 3 to 5%. A single family home, as long as the previous tenant doesn't destroy the property, then you can go in, generally get them rent ready fairly quickly and get them leased relatively fast. So I'm going to put 3% here. Now that gives you a net rental income of $24.20 per month. Okay, so now let's take a look at the expenses. And as I mentioned in the beginning of this video, you need to account for the expenses outside of just your monthly mortgage payment. And there's quite a few that are required to operate a property. So it's really important to be aware of these up front so that when you're analyzing a deal, whether it's an investment property or even a primary residence, you kind of understand and know exactly what you're going to be getting into. So what's nice about this form is it gives you kind of an idea here of the expenses on a property to expect, like property management fees, leasing costs, maintenance reserve, utilities, property taxes, insurance, all of that good stuff. But I'm going to walk you through each one real quick just to give you an idea of what to expect and sort of the information that you're going to be digging for as you look at these homes. So property management on a single family home out here in Sacramento, it should cost you about $100 a month, which in this case is probably somewhere around 4%. One thing that's kind of odd about this spreadsheet is that it doesn't tell you, you have to put the percentage over here right on the right-hand side in order for these tabs to populate. So that's about $95. Let's go ahead and kick it up to 5%. 5% is a little high, so let's go ahead and do 4.5. And that puts us at 106. That's fine, just for the initial calculation here. Leasing costs. Generally speaking, to place a tenant, you will pay a leasing commission. It is typically 50% of the first month's rent. And let's say that the average tenant stays for 2 years. Well, if your rental income is roughly $2,500, that would be $1,250 in total as a leasing commission spread out over a 2-year time frame. So let's call that about $600 a year. And that can be put right here annually, and it will automatically populate the leasing cost on a monthly basis, which is about $50. With maintenance reserves, if you are dealing with a newer property that's in really good shape, odds are the maintenance is going to be relatively small. If the property is 50 or 60 years old, then your maintenance reserve may need to be a little bit bigger than what I'm going to put here. But this home, I think it was built in the early 2000s. It's relatively new. You're probably not going to see a lot of repair work. So I'm going to guess that you're somewhere around $1,500 a year. Again, that's just a rough estimate, but it gives us an idea. Now, With regards to utilities, in most cases, the tenant is going to be responsible for the electricity and the gas, and the sewer, water, and garbage will fall on the landlord. Now, what you can do is you can prorate that utility cost that the landlord is required to pay, and you can charge that as a utility cost back to the tenant in some cases. Again, you need to check with your property manager on that. Okay, so let's assume that the sewer, water, and garbage runs about $150 per month, which works out to about $1,800 annually. Now, depending on where you live, you could potentially bill that $150 per month back to the tenant. If that's the case, you could go ahead and add that expense in here as additional income. So let's go ahead and do that. That kicks up your rental income by collecting for those utilities that you are required to pay as the owner. Now, property taxes out here in this region are about 1.2% annually. So if we pull out the calculator, paid $535 for this place, and we multiply that by 1.2%, it works out to about $6,420 annually. So we'll go ahead and populate that, $6,420. Homeowners insurance costs, let's just say for this particular property, it's going to cost you somewhere around $95 per month. Every market is different. Check with your insurance broker on that. I did that wrong. Let's say $95 per month times 12. That works out to about $1,140 annually. So everything here is calculated on an annual basis, and then they break it down into a monthly figure. Now, under the other expense, they are listing things like HOA fees, lawn care, trash, etc. We already accounted for trash in the utilities. Lawn care in our market can actually be placed on the tenant. So in this case, if there's no HOA, you can go ahead and put that as 0. Okay, so a couple things I want to point out. You have your net rental income up here, less the, well, let's change the vacancy rate back to 3%. Okay, so a couple things that I want to point out here. You have your net rental income plus the utility expense that's billed to the tenant. That's coming in at $25.65 per month. And then you have your total monthly expenses to run and operate that property coming in at $1,070 per month, giving you a net operating income of $1,495. So this is before you apply your mortgage payment. Now, if you look down here, your mortgage payment is $1,862. That's your principal and interest amount, which means that in this particular scenario, you would actually have a negative $367 per month in cash flow. That is not really a good scenario to be in. So how do we fix it? Well, there's a couple of things that you can look at. One, you can look at increasing the down payment. So in our market, it's a relatively expensive market, and if you're going to buy property as an investment, if you want it to cash flow from day one, a lot of times it will require 25-30% down, maybe even more in some cases, just depending on the area. So let's go ahead and adjust that. Let's say we're going to put down 25% in this case. That puts our down payment to about $134,000. And then let's say, again, this is hypothetical, but let's say the property can actually rent for $26.50 plus the utility expense of $150 per month. And this is something that you really need to dig deep in. I would highly encourage you to talk to a property manager, somebody that's in the market each and every single day, has boots on the ground, and can qualify this a little bit better than I can. Remember, it's just an estimate at this point, so you can quickly size up a property. And then let's go back down and take a look at our cash flow. Okay, so in this particular scenario, we still have $107 a month negative cash flow. It really doesn't make sense as a rental unless you would like a negative carry on that property. Now, you could make the argument that, well, the property probably won't have much vacancy, or, you know, these leasing costs will be lower. We might not need so much in maintenance reserves, or these utilities might be lower, or something along those lines. But at the end of the day, you can only play with these numbers so much. So let's go back up and let's see what happens if we put, 30% down. That's $160,000. Okay. Well, now we have cash flow of about $9 a month. So, for a quote unquote risk asset, is that a good enough return for you to deploy $160,000? That's probably not going to make a whole lot of sense, in my opinion, but everybody's situation is different. And when you're looking at these properties, you need to determine what you are investing for. Are you investing for cash flow, or are you investing for the long-term hold and appreciation? California is known as a cyclical market, which means that the prices of homes can make higher highs and lower lows, and so it's something you need to be aware of. But in my humble opinion, we always want to make sure that the property will cash flow or at least break even from day one. That way, in down markets, you have the security of that monthly cash flow to maintain the property and hold out until prices go up. Now, taking this one step further, let's go ahead and leave it there with basically no cash flow at this point. But let's say the average appreciation in this market is 3% per year. Lately, it's been substantially more, but let's say over the long haul, it's 3% per year. This sheet actually says the 20-year average is 4.4%, but I want to be conservative. Let's say rent appreciation is also 3%. And that is on an annual basis. And I want you to know that this is not linear. Home prices go up and down, but the long-term average, you could probably make a case for it to be 3% or a little bit greater in this market. And then let's just say the cost to sell the property is about 7%. That would be brokerage fees as well as closing costs associated with selling a property. So once we have basically this spreadsheet tweaked exactly the way you'd like, you have the numbers to where it's acceptable to you and the deal makes sense on paper. In this case, I'd probably, like I mentioned earlier, $9 a month cash flow is probably not quite enough. We'd probably want to either look at a different property as a rental, put more money down, or readjust some of these figures so that it pencils a little bit better. But let's just say that a break-even proposition is fine for you as an investor. Let's go ahead and look at the details over the long haul here. In order to do that, you can click on this second tab, and this breaks down all of the different things that are associated with this property. And so I'm going to run through this quickly, but it's rather telling over the long haul once you factor in price appreciation on the property, equity building up, paying down your debt, and then your total return over time. So starting in column 1, we have the property value start of year 1. If we're going up by roughly 3% a year, you can start seeing that how the property value increases over time. So year 2, year 3, year 4, year 5. 5 years in, this property is worth $600,000. Again, appreciation is not linear. So, past results are definitely not guaranteed for future. And then you can see your annual appreciation. It appreciates by about $16,000, $17,000 a year, and it increases over time. Here is your accumulated appreciation. So year 1 is $16,000, year 2 is $16,500, and that's accumulated appreciation of $32,500. Here's your property value increasing. This is the cost to sell or exit on a property. This goes up as well because brokerage fees are generally based on a percentage of the sale. Same with closing costs, so those go up as well. And then here is your mortgage debt. So starting year 1, this is what your mortgage loan is going to look like, and over time it gets paid down. So just 5 years into this loan, you're only going to owe about $334,000, where the original starting balance was over $367,000. You got to remember this is at the end of the year. And then here is your equity over time. So year 1, you have about $184,000 worth of equity, and year 5, right here, you have about $285,000 worth of equity. Cash flow accumulated, you can see that it's very, very low year 1 because you're only collecting like $8-9 a month, technically. And then over time, the rents rise. And so you can see that the accumulated cash flow starts to build up over time. Your initial investment here, $164,500. That was the down payment plus the make-ready expenses. There's probably some closing costs that you're going to have to factor in there as well. So that number might be a little low. Annual total return. This is your total return over time. And what that basically is that's your debt pay down, your appreciation in the property, plus your cash flow. And then look, here's your total return on investment, total ROI. So your your total return is based on a number of factors. Again, that is your debt pay down, your appreciation, and your accumulated cash flow. The next tab shows cash on cash return, which is obviously very low in the first couple years because the property is essentially just breaking even. So cash on cash return is how much cash or capital you deployed into the investment. In this case, it was $164,500, and you are earning approximately, $100 a year to start in cash flow, which is basically a 0% return. So what you have to consider here is if you have a sizable amount of money that you are looking to invest, this real estate is a risk asset. You can technically put $164,000 in a high yield savings account and earn 1% per year, essentially risk free. But what you do not get is you don't get the ability to leverage that debt, which essentially put a mortgage on it, which allows for the debt pay down. You do not get the cash flow, and then you do not get the potential appreciation of that asset. Now, this deal as it sits is a little tight, as I've mentioned previously, but over time it looks like it does okay. So let's keep going. Here's your total return on equity. You can see it's already in the double digits. And again, it's just for some of those things that I mentioned, like this, accumulated total return. Here's your accumulated debt pay down, your cash flow plus your appreciation. So that's year one. Here's the total for year 2, year 3, year 4, and year 5. You've had about $132,000 in total return. And then your total return on investment based on the accumulated total return, which is right over here. So it's about an 80% return on your money. That's not bad in 5 years' time. It really is not. Now here is your accumulated total return after COS, that's cost of sale. It's going to be less, obviously, because you have to pay those fees to exit the property, which gives you a total ROI after your cost of sale of 54%. So that's in 5 years. But what does this look like in maybe 10 years? So we know year one, you have a negative return because of the exit costs that are associated with leaving the property. 5 years, we know we make about 54%. But, in 10 years, let's see, 6, 7, 8, 9, 10. In 10 years, you make about $252,000 for a 153% return. Real estate is a slow-moving wealth builder over time. You basically plant the seeds, you till the land, and eventually you'll grow a tree which will yield fruit. 10-year time horizon is the minimum I would look at these rental properties, especially with prices being at record highs today. But what is not at record high is the debt. The 30-year fixed rate debt today sitting at 3.25% or less in some cases if you're buying it as a primary residence. I mean, in many cases, I almost want to look at the debt as an asset because the pay down on that over a 10-year time frame adds up. It's really substantial. And if inflation grabs hold and we have rent prices continue to rise as well as home prices continue to appreciate, the real estate can be a very, very powerful investment over the long run. All right, so that is going to do it for today's video. I would love to know what you think about how we analyze the rental property in this case. Obviously, it didn't cash flow very well, but that was just one deal that I pulled at random. So I would highly encourage you, if you are new to real estate or if you are considering becoming a real estate investor, or even if you want to buy your first home, this is sort of the framework in which I would look at these deals. I would take a look at all of the expenses, what it's going to take to run the property, what it could potentially rent for today, and then sort of extrapolate those figures out, 5, 10, 15 years even, just to give you a forecast on what this property will look like and how it will perform over the long run. Anyway, I hope you found value in this video. Would love to know your thoughts. Please feel free to comment below, list any questions that you might have. And if you haven't done so already, please consider tapping the like button, tapping that subscribe button to see future videos on finance, real estate, and investing. Again, thank you so much for taking the time to watch this video. My name is Lewis. Take care.